see what I'm trying to do here? Is look at the competition and come up with what everybody else is charging, so we know that where we should be, right, compared to where we're at. So just because the last year has just been crazy with prices and stuff. So prices just went up. Now it'll be interesting to see what happens, obviously, over the course of the next couple of years. Will prices come down? Probably, right? So you want to make sure that you have like a big enough spread, right, in your prices and stuff, But we're running this at a 7 cap. I mean, is it a 7 cap? Is it an 8 cap? Is it a 9 cap? We could run it at an 8 cap too if you want to. But essentially, we're taking, and the cap rate is really just what the market calls for. And the market cap rate is really what it calls for. Cap rate is really just what are you willing to pay for the deal, right? And if you know the market cap rate, then it kind of gives you an idea of really like where you should be. So we're looking at stuff always like, 8s, 7s. That's kind of where we're at. Like in a tertiary market, we stick to like an 8 cap, maybe a 7, depends on where it's at. I would say maybe 7 to 8 cap right now. Where do y'all think we should be on cap rate on this thing? Now, pre-COVID, it would have been, probably higher, but I don't think we're ever going to get super high cap rates again. I just really don't. The market is changing. So, okay, so now you can see our numbers here. I'm going to go back to the financing inputs. I'm going to put I put 220 is what we bought it for, right? And then we got a private lender. So I'm going to go to the bank private lending to lend us the money. And they gave us, we put 0% down, right? They just gave us $220,000. And we gave them 8% interest, and it's interest only, right? And they gave us, I think they gave us like 3 years is what it is. Okay, so we just put 3 over 3 is what we do. Okay, so yeah, so that's about right. So we're at $14.66 a month is where we're at for our mortgage. It sounds about right where we're at. Okay, and so you can see our cash on cash return. Obviously, we don't have any cash in the deal, so we're at 600%, cash on cash return. We're at 40% actual net after mortgage, right? And our cash flow, let's look at our cash flow here. So yeah, so we are at like, we're right now we're here. Okay, so we're at 173% cash on cash return. The net monthly income is around $600. So we're at $3,700 a month. That's about right. You saw the numbers, right? And operating expenses are about maybe $1,700 a month to run this thing. The NOI is at $2,000. We're going to minus our mortgage and come out to about $600 a month. Okay. And then once we get it to 90 cents, now obviously we're in the process of getting it ready to be refied out. And, we're going to watch the interest rates. I mean, we're at 8% interest right now. I mean, what's going to happen to the commercial interest rate? I don't know. We'll see tomorrow. No, not tomorrow. We'll see Thursday, right? So now you can see here, this is where we're at, bank financing, private financing. It's the same one here. So we should make over $5,000 a month on this thing. We're trying to get to $5,000 a month. Our mortgage, our monthly expenses are $1,700. That won't change, right? And then $3,600 is our NOI minus our mortgage at $1,466. So our net monthly income is going to be a little bit over $2,000. So our cash on cash return is 600%. Okay, so that's our goal. All right, now we'll see obviously what happens over the course of the next year or two. We'll see what happens. Is it going to be like a crash, or is it going to just like maybe come down a little bit? We'll see. But so that's basically our numbers for this deal. So the question of the day is, can you invest in tertiary markets and make money? Right now, look at this. I mean, essentially, we bought it for 220 grand. It's worth, like at an 8 cap, it's worth $310,000 right now. Us not getting it to where, to the 63,000. Once we get it up to over 60 grand, it should be worth at least $500,000 to $600,000. Okay, so we're going to triple, I mean, essentially we'll triple the value of the property. And these types of facilities, I really shoot for tripling the value of the property. All right, that over time, that's the goal. Like if I'm going to buy it for 200,000, I should be able to sell it for 600,000. Or if I'm going to buy it for 300, I should be able to sell it for 900. Something like that. It's kind of in my mind how I do it. You guys tell me what y'all think. But that's kind of how I do it. So, so I'll be able to sell this in 1031 exchange, 3 to 400 grand into a bigger deal. All right. Now remember too that we create many portfolios, right? So, we're looking at we have one in Valdosta that's just like an hour away. And like we shoot for an hour away and try to get 3 or 4 of those facilities in an area. And that's what we'll be doing because we're in the process of moving down to Florida right now. And our focus is really like North Florida, South Georgia, and building that out as well. Anywhere in Georgia is fine, but like that's kind of like I want to build some portfolios down there. So that's our goal. And so I wanted to show y'all kind of what our numbers are, and the question of the day is, can you make money in small markets? Obviously, you don't make like millions of dollars if you go and buy a huge, big facility and stuff, but like, yeah, you can make money, try to triple the purchase price. That's your goal. All right. I think that's a good, place to start. And, some of them are, if they're income producing properties that are like, cause this one was it was making like $2,400 a month or something when we bought it, or maybe at the most 3,000. So it wasn't making what it should be making. It just takes a little while to get that kind of going. And, but we always shoot for tripling, like mismanaged facilities, tripling the value of that property. Income producing properties, it could span from just like a little bit of money to a lot of money as well too. So just keep that in mind.